Welcome to the Deep Dive, your ultimate shortcut to being truly well-informed. Today, we're putting on our Talk Tickers hats. We're going to cut through the noise of a recent earnings call, pulling out just the most vital insights for you. No information overload here. Our focus today is the second quarter 2025 earnings call for AOS Smith. They're a genuine global leader in water technology. This deep dive is really tailored for you, whether you're maybe gearing up for a big meeting, getting up to speed on the sector, or, just have that insatiable curiosity about what makes these major players tick.
Yeah, and we've distilled everything. We're talking pivotal financial numbers, key management insights, right down to their updated guidance. What really stood out to me from this call is how the new CEO, he's already very clearly steering the ship, especially, when it comes to their international strategy and identifying those critical future growth levers.
So what does all of this actually mean for investors, for the competitive landscape, for anyone just trying to understand the pulse of this market? Let's really unpack this. All right, let's jump right into the headline numbers for Q2 2025. What were the absolute top-line figures that caught your eye?
Well, the top-line story is pretty interesting. The company reported total sales of $1 billion.
Okay.
Which is actually a slight dip, down 1% year over year. But despite that dip in revenue, earnings per share, EPS actually saw a modest increase, up 1% to $1.70 per share.
Huh. So that suggests maybe some underlying strength and profitability.
Exactly.
And how did that break down across their different segments? I noticed the North American numbers looked, quite particular.
Absolutely. North America's segment sales came in at $779 million, also down 1%. They attributed that to a tough prior year comparison, which makes sense.
Right.
The rest of the world segment posted sales of $240 million. That was down 2%. Though it's worth noting that figure did include a $16 million boost from their recent Pureit acquisition.
Ah, okay. So without Pureit, that segment would have seen a larger decline then.
Correct. Yeah.
So from a profitability standpoint, how did these segments perform, especially, given those slight sales decreases?
Yeah, this is where it gets really interesting. North America segment earnings were essentially flat year over year at $198 million. But their operating margin actually improved.
Really?
Yeah, by 30 basis points, that's 0.3% to 25.4%. So they're getting more efficient, even on slightly lower sales.
Wow. Okay.
The rest of the world segment earnings were $25 million, also flat, with a 10.5% operating margin. The big question this raises is, how did they manage to maintain or even improve margins despite, lower sales in certain areas?
Yeah.
It really points to some very effective cost management.
Okay, so let's really dig into that North America segment then, since it represents, the lion's share of their business. What's the granular story behind those water heater sales specifically?
Right. North America water heater sales actually decreased by 2%, largely due to lower volumes. The industry tends to see customers buy ahead of anticipated price increases or maybe tariff risks.
Mm-hmm.
What's different this year, and what the company really highlighted, is their proactive approach. They've apparently been working closely with customers to smooth out production schedules.
Okay.
So while there was still some pull forward of demand, it was less dramatic than in 2024.
Ah.
And they expect to gain operational efficiencies throughout the rest of the year by avoiding those, boom and bust cycles.
Right. That makes sense. But then, almost counterintuitively, North America boiler sales bucked that trend completely, didn't they?
They absolutely did, yeah.
Yeah.
North America boiler sales increased by a healthy 6%.
6%?
Which was driven specifically by higher volumes of their high-efficiency commercial boilers. This is a segment with strong demand, particularly as buildings look for more energy-efficient heating solutions. It's clearly a bright spot for them.
Definitely. And what about their water treatment business in North America? How is that evolving?
Water treatment sales saw a slight increase overall. They're making a strategic shift here. Growth in what they call priority channels like e-commerce, dealer networks, and direct-to-consumer is actively offsetting anticipated declines in the less profitable traditional retail channel.
Okay, so a deliberate move away from retail there.
Exactly. This deliberate channel mix shift is really helping improve overall profitability. It's contributing to that North America segment operating margin expansion we discussed earlier. They're targeting an impressive 250 basis point or 2.5% operating margin expansion for the full year, just in this particular business.
That's a significant margin target. Now, management talked about broader industry dynamics that might have impacted their market share in the first half. What exactly were they getting at there?
Yeah, they believe the broader industry took a more aggressive stance in fulfilling order demand than AOS Smith did. Essentially, some competitors might have overshipped or, pushed product out faster. This led to some temporary market share pressure for AOS Smith in the first half.
Okay.
However, they anticipate a market share recovery in the second half as they work through their existing backlog and as customer ordering patterns, normalize.
And on the competitive front, you hear about new players eyeing the North American water heater market. Did management sound concerned about that?
Not particularly, no. They reiterated the significant challenges new entrants face. They stressed the need for a full product portfolio that's readily available because of the high replacement rate of water heaters, plus the sheer complexity of navigating all the evolving regulatory changes.
Right. It's not simple.
It's a high barrier to entry, definitely. And they feel their established infrastructure and relationships give them a durable competitive advantage.
Okay. Let's shift our focus now to the rest of the world segment, particularly the complexities surrounding their China business. What's the story there?
Well, it's a bit of a mixed bag internationally. While their legacy India business continued its impressive growth, up 19% in local currency, which is great.
19%, wow.
Yeah. But China's third-party sales decreased by 11% on a constant currency basis. This was largely attributed to ongoing macroeconomic challenges there, and also the limited availability of government subsidy programs outside of the top-tier cities in China.
So despite those lower sales in China, were they able to maintain profitability? How did margins look?
Surprisingly, yes. They managed to keep their operating margin flat year over year in China.
Flat, even with sales down 11%.
Exactly. It speaks volumes about the effectiveness of their 2024 restructuring initiatives and other, stringent cost control measures they put in place. These efforts are expected to deliver significant $15 million in annual benefits. It shows a real focus on managing what they can control in a, frankly, challenging market.
That leads perfectly to this next point, which sounded pretty big. The company announced they're formally assessing their China business. This isn't a small move. What exactly does this mean for AOS Smith?
Yeah, this is a major strategic pivot. They're evaluating a broad range of options that includes strategic partnerships, other alternatives. It's all aimed at best positioning the business for future success. While they acknowledge the current macroeconomic headwinds in China, they genuinely seem to believe the market holds substantial long-term potential.
Why?
Well, they cite their premium brand position, their innovation capabilities, and that strong distribution network they've built. They stressed they're committed to realizing the full potential there for shareholders and employees.
That begs the question, though, why now? Is this a signal they're planning to divest the China business entirely? Are they looking to get out?
Management was very explicit about this. They stated this is about broadening their horizon of options, exploring every avenue, and being fully informed about the right path forward.
So not necessarily divestment.
Definitely not a predetermined decision to divest is what they said. They want to understand what makes the business perform at its absolute best. Could be a new structure, could be a new partnership. It's a proactive assessment, not a reactive retreat.
Okay, that's clear. Now let's pivot to the company's financial health and how they are approaching capital allocation. What's their cash position looking like?
Pretty strong. They generated operating cash flow of $178 million and free cash flow of $140 million during just the first 6 months of 2025.
And that's better than last year.
Yeah, actually higher than the same period last year, primarily due to lower working capital needs. Their cash balance stood at a healthy $178 million at the end of June. And importantly, they have a very low net debt position of just $126 million. That reflects a remarkably low leverage ratio of 14.1%.
Wow.
Which indicates a very, very strong balance sheet.
Okay. And what are they doing with all that financial flexibility? I saw some notable movements in share repurchases.
Indeed. Yeah, the board approved a quarterly dividend of $34 per share, signaling confidence. But what's truly fascinating is their aggressive share repurchase activity. They bought back approximately 3.8 million shares for $251 million just in the first 6 months of 2025.
251 million.
Right. And they've increased their full-year repurchase intentions now to approximately $400 million. That's a huge jump from just $36 million in 2024.
That's a massive increase.
It's a clear commitment to returning value to shareholders.
Beyond repurchases, are they eyeing any acquisitions? Do they have enough dry powder for that?
They absolutely are. Management highlighted they are actively assessing strategic M&A opportunities and confirmed they have sufficient dry powder, cash reserves for suitable acquisitions. They're prioritizing deals that either strengthen their core businesses or help build new growth platforms.
Right.
And the new CEO even indicated openness to considering something more transformational down the line. He described it as adding another leg to the stool, so to speak.
Interesting. Another leg to the stool. Okay. So with this new CEO at the helm, it's always crucial to understand his strategic priorities. What did he outline as his key focus areas moving forward?
Yeah, he laid out 3 clear pillars to drive value. First, operational excellence.
Okay.
This involves accelerating productivity, eliminating waste, really expanding the application of their AOS operating system, applying lean principles, not just in manufacturing, but like across all end-to-end processes, and leveraging technology investments to do so.
Makes sense.
Second, innovation. Building on their strong R&D legacy, they highlighted new product launches like the Adapt SC gas tankless water heater with integrated scale prevention. Also the Home Shield whole house water filter certified for PFOA reduction that's reducing those, forever chemicals.
Important.
Very. And the upcoming Cyclone Flex commercial water heater, specifically designed for the 2026 regulatory changes. They even announced a new Chief Technology Officer, Dr. Ming Chang, signaling a renewed push there.
Okay, innovation is key. And the third pillar?
Third, portfolio management, which involves continually evaluating their business portfolio. We see that with the China assessment, right?
Right.
And prior restructuring actions in China and North America water treatment. M&A and strategic partnerships are seen as critical levers for this part of the strategy.
Okay, that's a very clear strategic roadmap. Let's bring this together then with their updated 2025 guidance. What are they projecting for the full year now?
Well, they raised the midpoint of their full-year earnings per share outlook. It's now a narrowed range of $3.70 to $3.90 per share. That implies about a 2% increase over their 2024 adjusted EPS.
Okay, and does that account for cost pressures?
It does. This outlook factors in a pretty significant 15-20% increase in steel costs. And the full impact of currently announced tariffs hitting in the back half of the year, which had minimal impact in the first half, they estimate the annualized tariff impact on total company cost of goods sold will be an increase of approximately 5%. But they stress they have mitigation efforts ongoing.
So even with those significant cost pressures from steel and tariffs, they still raised their full-year sales outlook. I thought I saw that.
You did. They bumped it up from flat to 2% growth, now to an increase of 1.3% compared to last year.
That's a strong vote of confidence then.
It absolutely is. Their confidence seems to stem from their proven ability to manage costs, that expected improvement in market share in the back half of the year we talked about, and the strong performance from their boiler sales. They really see a path to profitable growth despite the, macroeconomic uncertainties out there.
Okay, this is the part where we put on our most speculative yet plausible hats for a quick trade idea based on all this information. And remember, folks, this is absolutely not financial advice, purely a thought experiment, okay?
Absolutely, purely theoretical. So, given AOS Smith's strategic assessment of its China business, their commitment to maximizing potential, remember, not necessarily exiting, and their significant dry powder for M&A, here's a thought. You could, hypothetically, consider a long position in AOS Smith itself, perhaps coupled with a short position in a smaller China-focused domestic appliance manufacturer.
Yeah.
Maybe one that heavily relies on government subsidies or is more exposed to the challenged Tier 3 and Tier 4 city property markets over there.
So the rationale there is you're kind of betting on AOS Smith's disciplined approach. They unlock value from China, maybe through a partnership or even a smart divestment, allowing reallocation. And at the same time, you're hedging against the broader China macro weakness by shorting maybe a more vulnerable local player.
Exactly. It's a play on smart, active portfolio management and leveraging that strong balance sheet amidst market uncertainty. It draws directly from the nuanced discussions in their earnings call. A wild thought, maybe, but one that ties directly into their announced strategy.
Definitely food for thought. Okay, that brings us to the end of our deep dive into AOS Smith's Q2 2025 earnings call. We've covered quite a bit, everything from their segment performance and those strategic operational shifts to their robust balance sheet and those crucial future growth priorities.
Yeah, the key takeaways seem pretty clear. We're looking at a resilient core business, but with significant strategic shifts definitely underway, especially in China. They have a disciplined approach to operations that's yielding results, you see it in the margins, and a very clear intent for aggressive capital deployment, whether that's buybacks or M&A. They sound confident in their future and their ability to achieve profitable growth, even with the ongoing macro uncertainties.
We really hope this deep dive has given you a concise yet comprehensive understanding of the company's performance and outlook, hopefully provided you with that valuable shortcut to being well-informed.
And just one more time, always remember, the information presented here is strictly for informational purposes only. It is not financial advice. Please do your own research, consult with a professional before making any investment decisions.
Absolutely. So what insights stood out most to YU in this deep dive? We always love hearing your thoughts. Until next time, stay curious and keep learning.